As dividend investors, we want to find the best companies to buy, hold, and collect their growing dividends. But you're busy, and finding great dividend stock ideas isn't always easy. So I looked at and am happy to share with you the top 10 blue chip dividend stocks billionaire Ray Dalio's Bridgewater Associates most recently bought, including one position that saw an increase of over 10,000%. Hey, what's up? I'm Russ, and I've been a dividend growth investor since 2018, and on this channel we talk about making money primarily through dividend growth investing. So check it out. Institutional investment managers with at least $100 million in assets under management must file a 13F within 45 days after the last day of the calendar quarter. So I love looking at 13Fs for dividend stock ideas to see what some of these fund managers are buying, but you always have to remember that you cannot just buy because you saw it in a 13F, because that information could be anywhere from 45 days to 4 months old. And remember, it's just a snapshot of that day and time when they filed the 13F. And the very next day, they could have blown out of some of those positions, and there you are buying them. So never ever buy just because you see it in a 13F. And with that being said, we know that stocks are sold for hundreds of reasons, but they are bought for only one reason, because they are expected to increase in value. And Ray Dalio has a net worth of $19.1 billion and runs the aforementioned Bridgewater Associates, which manages about $154 billion. So when they add to positions and add big, we should definitely take note and see if any of these positions make sense for us at their current valuations in our portfolios and our investment journeys. Just like Ray Dalio did with the number 10 added position, they increased, which was Costco, ticker COST, by 2% to 121 million shares, which marks 8 consecutive quarters of addition and accounts for 2.45% of their portfolio. Costco is a warehouse club giant, which has 815 worldwide stores, has membership renewal rates around 90%, which allows them to continue to aggressively price merchandise. Costco has enjoyed a 9.77% total return versus the S&P 500's negative 12.45 over the last year. They have a 0.73% dividend yield, 17 years of dividend growth, and they sport a tippy-top Simply Safe dividend score of 99. Bridgewater also increased their position in the US's largest food distributor, Sysco Corp, ticker SYY, by 16% to 168 million shares, also for the 8th consecutive quarter. Sysco is 0.6% of their portfolio and is a low-cost distribution leader that actually increased their material market share during the COVID-19 pandemic. Sysco almost has a 5% total return the past year, a dividend yield of 2.5%, 53 years of dividend growth, and a Simply Safe dividend score of 70. Moving on to number 8. For the second straight quarter, they've increased their Walmart, ticker WMT, stake, this time 17% to 4.7 million shares. Now, Walmart is America's largest retailer by sales and operates approximately 10,500 stores and clubs under 46 banners in 24 countries and is a healthy 2.42% of their overall portfolio. Walmart has about a negative 4.25% total return over the last year, a yield of 1.66%, a 48-year dividend growth streak, and a Simply Safe dividend score of 90. Sticking with retail, next we move to a company they added for the 8th consecutive quarter as well. Now, Ray increased their share of Target, ticker TGT, this time by 18% to 1.56 million shares to make up 0.93% of the Bridgewater portfolio. Now, Target has just over 1,900 stores that they have been renovating. They've made enhancements to their loyalty program, and with their purchase of Shipt are pushing further into e-commerce. Over the last year, Target has a total return of almost negative 33%, currently yielding yielding almost 2.75%. They are a brand spanking new dividend king with 50 years of growth and a Simply Safe dividend score of 90. In the number 5 spot, we see that Bridgewater up their Medtronic, ticker MDT, position by 34% to 2.51 million shares, which is a relatively new position for them and already accounts for 0.95% of their total holdings. Now, Medtronic is one of the largest medical device companies that manufactures products like pacemakers, which they invented, defibrillators, heart valves, and surgical tools. Over the past year, Medtronic is down almost 32%. They have a yield of 3.17%, which is almost 50% above their 5-year average, and they have been growing that dividend for 44 straight years, and they also have a top Simply Safe dividend score of 99. In the number 4 slot, and accounting for 0.56% of the Bridgewater portfolio and having been increased for the 4th straight quarter, Mr. Dalio bought more of General Mills, ticker GIS, which increased their position by 47% to 1.78 million shares. Now, General Mills' largest brands are Nature Valley, Cheerios, Old El Paso, Yoplait, Pillsbury, Betty Crocker, Blue, and Haagen-Dazs. Jizz has a very healthy total return of over 41% the last year, a 2.71% dividend yield, and while they have only 2 years of dividend growth, they have not missed a payment in almost 125 years, and Simply Safe Dividends gives them a safety score of
69, dudes!
Now, it's only been 2 consecutive quarters, but Bridgewater increased their stake in ExxonMobil, ticker XOM, by 67% to 1.91 million shares, which is good for 0.69% of the Bridgewater portfolio. ExxonMobil, if you didn't know, explores for, produces, and refines oil around the world, and in 2021 they produced 2.3 million barrels of liquids and 8.5 billion cubic feet of natural gas per day. Per day! A huge total return of 77% over the last year, 39-year dividend growth streak, and check it out, they have not missed a dividend payment in 140 years. And Simply Safe Dividends gives ExxonMobil a safety score of 80. We've made it to the top 3, and accounting for 1.23% of the Bridgewater portfolio, CVS, ticker CVS, was heavily bought by Mr. Dalio with an increase of 160% to 3.15 million shares. Now, CVS already has almost 10,000 stores, and in 2018, they acquired Aetna Insurance, making them an integrated healthcare giant. Now, if we look back 1 year, CVS has a total return of 21.5%, a dividend yield of 2.21%, and while Simply Safe Dividends shows no growth, they actually increased their dividend 10% in December of 2021 and have not missed a payment in 25 years. The old SSD tags CVS with a safety score of 90. So if you've made it this far, leave an emoji in the comments below. And if you found this helpful, please do give the video a thumbs up, consider subscribing, yada, yada, yada. And I also have a weekly newsletter that you can find the link for in the description below. I hope you will sign up. And on to the top 2, they went heavy buying MasterCard, ticker MA, increasing their position, which they started in Q1 of 2022, 1,242% to 485,270 shares, which accounts for 0.64% of the portfolio. MasterCard is the second largest payment processor in the world. They operate in over 200 countries, process transactions in over 150 currencies, and they have actually been outperforming Visa in terms of growth. Now, MasterCard is down a little bit with a total return the last year of negative 9.25%, currently paying a 0.64% dividend yield. They have a 10-year dividend growth streak, and they also receive a maximum safety rating of 99. And that brings us to the number 1 position, and if you skipped ahead to number 1, hey, what's up? We're happy to see you here and let you know that Nike, ticker NKE, is the dividend-paying company that Bridgewater Associates increased their position size by a whopping 10,740% to 224,200 shares. Now, Nike is the largest athletic footwear and apparel brand in the world. Analysts think that more than 70% of Nike's growth over the next 5 years could come from outside of North America. Nike's margins could also expand due to increased innovation, direct-to-consumer sales, and digital membership growth. The past year hasn't been very kind, as Nike's total return is negative 35%, and their current yield, though, is about 1.22%, which is 22% above their 5-year average. They have a 20-year dividend growth streak, of which they increased that dividend very rapidly, as evidenced by their 16% 20-year CAGR, and this should be able to continue for some time, as their free cash flow payout ratio is only 42%. And rightfully so, Simply Safe Dividends gives them a top safety score of 99. So which of these stocks do you own? We would love to know. Share it with the community by leaving your comment below. And speaking of buying dividend stocks, I have a super easy and stress-free way for you to buy and receive dividends. Well, if you'd like to know more, it's right here in this little itty-bitty box next to my head. So if you click that, I will talk to you there.